1980s. Wall Street is expanding at a historic pace. Money is moving faster than ever. New fortunes are being built overnight. In Manhattan, behind polished doors and private offices, a man with no traditional financial background begins entering rooms filled with billionaires. No MBA from Harvard University, no long Wall Street resume, no famous firm backing him. Yet somehow, he gains access to some of the wealthiest individuals in America. Jeffrey Epstein. He presents himself not as a typical broker or fund manager, but as a financial strategist for the ultra-rich. He claims to specialize in something different, protecting and multiplying vast fortunes quietly. Soon, powerful names begin to appear around him. Politicians, academics, billionaires. Among them, Bill Clinton, Donald Trump, Prince Andrew. How does someone with such an unconventional start gain this level of access? How did Jeffrey Epstein rise from obscurity to become a financial advisor trusted by some of the most powerful people in the world? Jeffrey Epstein did not begin as a Wall Street prodigy. He began in classrooms. At New York's Dalton School, an elite private institution, he taught mathematics and physics despite lacking a completed college degree. On paper, that detail should have limited him. In reality, it did something else. It placed him in direct contact with families whose wealth spanned industries. Education became access. Access became opportunity. Parents of Dalton students included hedge fund managers, corporate executives, and financiers. Epstein wasn't simply teaching equations. He was observing how wealth behaved, how powerful families thought, how they protected assets, how they valued discretion above publicity. That understanding would define his entire strategy. Through connections formed at Dalton, Epstein entered the investment bank Bear Stearns in the late 1970s. Bear Stearns was aggressive, competitive, performance-driven. But Epstein wasn't known primarily as a trader. He gravitated toward wealthy clients. At major investment banks, prestige is built through performance metrics. Epstein focused on something else: relationships. Ultra-high net worth individuals do not behave like retail investors. They prioritize tax efficiency, asset shielding, estate planning, legal insulation, cross-border structures. Epstein learned that managing wealth at that level is less about beating the S&P 500 and more about preserving dynasties. After several years, he left Bear Stearns under circumstances that remain somewhat unclear. But by then, he had absorbed something critical. You don't need the biggest firm. You need the right clients. In the early 1980s, Epstein founded his own financial advisory firm. Unlike traditional asset managers who compete for scale, Epstein marketed exclusivity. He claimed he would only work with billionaires, not celebrities, not institutional funds, only individuals with extreme wealth. This strategy accomplished three psychological effects. 1. It signaled elite access. 2. It discouraged scrutiny. 3. It created perceived scarcity. Scarcity builds value. If someone claims they only accept a handful of clients, the assumption becomes they must be exceptional. There was little public documentation of his strategies. No annual letters, no transparent reporting, no public filings that revealed detailed portfolio construction. His firm operated more like a private consultancy than a hedge fund. Opacity became part of the brand. Epstein understood something subtle about power. Influence compounds socially, not just financially. He began positioning himself within elite intellectual and political environments. He funded scientific research. He donated to universities. He attended high-level conferences. He cultivated friendships across sectors. Through association, credibility grows. Among the high-profile individuals he became connected with were Bill Clinton, Donald Trump, Prince Andrew. These associations did not necessarily define his work, but they strengthened his perceived status. In elite circles, perception matters enormously. If powerful individuals are seen around you, others assume legitimacy. One of the most unusual aspects of Epstein's career was the lack of transparency. Most major financiers leave paper trails, regulatory filings, investor disclosures, public investment theses, media interviews. Epstein did not. Reports suggest he focused on complex tax strategies, offshore structures, and trust arrangements for wealthy clients. Some accounts describe him as advising on asset protection rather than actively managing diversified portfolios. This distinction is important. Asset management seeks growth. Asset structuring seeks protection. For billionaires concerned about liability, lawsuits, estate transfers, and tax exposure, structuring can be more valuable than returns. But because of the secrecy, the full scope of his financial operations has never been publicly mapped in detail. Mystique filled the gaps. For decades, Epstein operated largely outside mainstream scrutiny. He did not seek television exposure. He did not publish financial thought leadership. He did not brand himself publicly. Instead, he relied on private introductions, word of mouth among elites, closed-door meetings. In high finance, silence can signal sophistication. The fewer interviews you give, the more important you appear. But silence can also conceal risk. In 2008, Epstein faced criminal charges related to serious offenses. The case attracted national media attention and raised questions about his network. Yet, despite the scandal, parts of his professional and social network persisted. This is one of the most debated aspects of his story. Why did some associations remain? In elite systems, relationships are often complex and transactional. Reputation damage does not always result in immediate severance, especially when legal resolutions are structured through agreements rather than trials. The financial world is deeply pragmatic. But the 2008 case created fractures. Some distanced themselves publicly. Others denied close ties. Institutions began reassessing connections. Still, Epstein continued to move in influential environments. In 2019, new federal charges were brought against him. This time, the investigation was broader. The scrutiny was intense. Public awareness surged globally. Media coverage became relentless. What had once been discussed quietly in financial circles was now front-page news. Past associations were examined. Photographs resurfaced. Donations were questioned. Institutions that had accepted funding from him began reviewing their processes. Universities initiated internal investigations. Political figures issued statements. Corporate leaders reassessed reputational exposure. The persona of the discreet financial strategist unraveled. His arrest marked the definitive end of his influence. His death in custody intensified public skepticism and fueled widespread speculation, shifting the narrative from private scandal to systemic inquiry. By this stage, the story was no longer confined to one man. It evolved into broader questions. How do elite networks protect themselves? How does wealth influence accountability? How do institutions vet donors and advisors? Epstein's career highlighted a recurring dynamic in high finance. Access can shield individuals from scrutiny until scrutiny becomes unavoidable. His rise had been built on proximity to power. His fall was amplified by the same proximity. The very networks that elevated him became the focus of investigation, and once secrecy dissolved, so did the aura that sustained him. Jeffrey Epstein's story is not one of innovation. It is one of access. He demonstrated how influence can be built not only through skill, but through positioning, through proximity, through exclusivity, through perception. For decades, he navigated elite circles with remarkable effectiveness. But his legacy is not financial. It is cautionary. His case exposed weaknesses in elite accountability, institutional transparency, the relationship between wealth and influence. Universities re-examined donations. Politicians faced scrutiny. Financial institutions faced questions about due diligence. The illusion of credibility, built through association, proved fragile. Jeffrey Epstein did not reshape an industry through invention. He revealed how power networks operate in the shadows. He showed that in the highest levels of finance, access can be more valuable than strategy, and perception can be more powerful than proof. But he also proved something else. When secrecy collapses, so does the structure built upon it. His rise was built on exclusivity. His fall was driven by exposure. And in the end, his story became less about money and more about the cost of unchecked influence.